Hello, folks. Welcome to Market Trends. I'm David Russell, Global Head of Market Strategy at TradeStation Group. It's great to be with everyone today on Thursday, June 5th, 2025. We're going to start with some disclosures. I'm going to share some links also in the chat. Wanted to do a flashback to something that we did earlier in March that I'm going to share as well about ADRs. ADRs are American Depository Receipts. They are international stocks that trade in the United States. And we did a mention of them back in March when we started to see the strong global outperformance. And we're not going to get into it, those individual things too much today. We covered it back on March 6th, I believe it was. There's a special workspace with a whole bunch of foreign stocks listed in it that you can go through in Radar Screen and check it out. That is in the chat right now. Okay, those are some disclosures. We're also going to jump over here and look at some standardized returns of some of the ETFs that we are potentially going to discuss. Now, today, our title is US Dollar Crumbles as Jobs Fade. And this is something we've been kind of noticing, and we're going to get to it, but, an increasingly kind of weakening economic picture, which is not necessarily a bad thing. But that is essentially what is taking shape. Today's look at the market, we have an outside day flirting right at 6,000 on the S&P 500. A range that we have been talking about a lot is in effect. Okay, these are the disclosures. Now, go to tradestation.com. If you go down the page, you're going to see here, it didn't appear. Sometimes it doesn't pop up. All right, so we go to Insights and go to Market Insights, and it will bring up our Market Insights blog. Now, on the Market Insights blog, you're going to see this article, US Dollar Crumbles as Jobs Fade. And this has a lot of the key information we're going to be talking about. I'll also mention to you that at the top of it, we have the downloads, which include all the workspaces we're going to be working with. And if you go down the page a little bit, there's this thing here. There's also a link, special report on ADRs from back here on March 6th, if you want to look at that one at the time. So basically, I'm looking at the overall market right now. And there's a few things I want to kind of look at. Let's go here to one of the things that we have shared with you guys is called MTES version 2. But essentially today we have an outside day on the S&P. Now we have seen these kind of patterns before. This is the S&P overall. And what's interesting about this is that this is the hourly chart. Now, let me get very quickly. I'm going to make it a daily just to show. And in this case, you can ignore the line. The moving average. In this case, so we had an outside day back here at the top of the range at the time, all the way back here. It to be kind of in the middle of May. I think on this day right here, it was the 13th or so. We started talking about the range that was likely to emerge based on this cluster of price action over over here. And basically, what's happened is we've gone up. We had an outside day and we swiped back down. Now we have another outside day today at the top of the range. So we'll have to kind of see. But from my view here, this is kind of consistent with range-like behavior. We have payrolls tomorrow. We have Broadcom earnings this afternoon. So those are potential catalysts. Right now, we have a little bit of a sense that China and the United States are going to be talking some more. So regardless, this is just where we kind of see the price action right now, the market kind of remaining stuck here. You can get into periods like we emphasized on State of the Market on Monday, that the market can get into long periods of being stuck and individual names perform. So in our rundown today, we actually highlight the volatility cycle. The market goes through periods of intense volatility here, more correlation, lots of volatility. And then you get over here, less correlation, stock picking. The VIX falls, and this is kind of where we are now. And you can be in a period of low volatility stock picking for a long time with the market. The index is not making significant moves. So that was the daily chart. Let me put this back to hourly. This is designed to show the, on this one, the yellow line will show the 10-day simple moving average. It's actually 70-hour moving average, which is the same thing as 10 days in a simple. Wanted to point that out. But to me, what's standing out to me here is the fact that, in some ways, the moving average is not as important to me as the range that we're seeing. So like I said, we went up and we flirted with the high. You can see it back here, this high back on the 29th also. But we went up and we basically failed to hold it. So this is now the the futures. That was the cash. This is the futures. And this kind of morning here, we see this kind of false breakout with that outside candle. So when you have an outside candle at a range, see here, it's a bullish outside hour. And guess what? It was bearish. So, I mean, these are some of the things we're seeing here. And this is now looking like we could have some signs here of a false breakout and getting sucked back down the range. It's not necessarily the most bearish thing because we're at the top of the range. And we've emphasized, look in the article here, we actually emphasize the range here that's in place, these two levels here between 59.94 to the upside on the cash index and 57.73, which is a low from January. So I would just say that in some ways we look overall right now, we can see the breadth is weakening, but it's really nothing fatal. And this is very much consistent with the kind of stock pickers drifting sort of market. I would say the main risk is that we get sucked back down the range. Now we have Trump and Xi talking today. One of the other things I want to talk about here is the dollar, US dollar, DXY is a trading view chart. I'm going to very quickly jump over to a 2-week chart here in trading view. Just to show here the dollar. And what I think is important here when we look at this is that this is, the level from when the Fed was hiking rates. This was like kind of peak hawkishness of the Fed in some ways. And now we're at a spot where, on a very long-term chart, these are very long-term trend lines here. I'll show you in a second. But the key thing is we have a support level from July 2023 that we are not bouncing at very much. We're sitting and grinding at it. And one of the things I want to kind of say is that, we could have very well be here at this moment, be at a spot of peak hawkishness. And if that is the case, and we see more of a sort of downside or more of a dovishness in the Fed starting to go from super hawkish to more dovish, more concerned about jobs, more concerned about the economy, less concerned about inflation, then that is something that which could be a negative on the dollar. It could be a very blissful downside on the dollar, though, when it's a very risk-on sort of thing. Imagine, for example, the economy slows and we start getting more job losses, but then they make progress on trade with China. Those two things together could actually be potentially the most positive for risk appetite, and that might be what we see. So let's not, just because some of these things sound negative, let's not misunderstand them. All right, so if you look overall, this is, to me, something I think you have to realize the dollar index has downside space. But and then the next thing is that we are continuing to see kind of weakening on the job growth, but it's not broken yet. It's a very strong job market, and it can take a lot of weakening before it really gets into negative territory. So it's kind of a Goldilocks trying to take shape. I think it's the way to think about it. It's not clear yet. Also, interesting, we look at the Fed watch from the CME. This is the July probabilities, and we're now kind of creeping back to, before everyone was certain it was going to be June, but now that's gone. But here we have this is a current rate. So you can see a week ago, we were basically at 78% no cut. Now we're at 69% no cut. So we're starting to see a little bit of probability here coming back in. And this is what I've been saying pretty much since last week, that peak hawkishness may have occurred. And the reason is that oil is weak, rents are falling, and those are going to kick through to inflation. And we're also seeing the weakening in the job market. That continuing claims number last week was very meaningful, and we're going to get to that. So I think right now we're at a spot where potential rate cuts are coming into play. Now, before we go forward, I want to show you one other thing we've introduced for you guys, because, the thing is AI is obviously a key thing in the world of trading now, because of all these stocks that are involved with AI, like Broadcom this afternoon. But AI is also something that we're embracing here at TradeStation, and we have now something called Insights AI. So you go to TradeStation on the main page, go to Insights, and then click on Insights AI. This will take you to a new page we have when we are using artificial intelligence to kind of summarize and track the most important stocks in the market overall, the most actively traded stocks. So what it does is it basically looks at, I can't remember how many now. I think it's maybe 50 stocks. I can't remember the number. But we designed this, and basically what it shows is it shows stocks that are outperforming or underperforming in the last month. And so you can see the last 21 trading days. You can say, all right, these are underperforming. You can then click on the stock, and it will bring up basically every night. It goes through and it reads the news. It reads different sorts of things, and then it summarizes it based on news from Benzinga. And this is all just, with ChatGPT and stuff. We all kind of built a system to make this work. So I want to just kind of share this with you guys. You can go through, it kind of summarizes different sort of results and things like that. There's a first iteration of some of the things, and we're really proud to bring to you guys and to just show you that, there are more and more ways going forward, and we're very much committed to always kind of bringing some, what we can, the cutting edge for you guys. Bring some other news and stuff down here. But I just want to let you know about this. You go to tradestation.com and then you go to Insights on the main nav bar, and then Insights AI. So I'm going to close that. Back to this. Okay. I also want to tell you that today we're going to look at some of these metal stocks that are getting interesting. I think I didn't really appreciate the potential seriousness of this rare earths thing. And I think it snuck up on people. Everyone was focused on the overall tariffs and stuff like this, but China appears, and I'm not an expert in this, but it looks like they have essentially locked out a lot of rare earths for most Western, like Europe, United States, I think India. The key thing is at a certain point in time, we get to a spot when we'll basically start running out of magnets and stuff like that, and it could have all kinds of negative consequences. So this could now become something more problematic. I think that's what the market's focused on. There will be, that's what all this stuff with Trump and Xi is important, but there's also, this is starting to become more of a trend where people are looking for stocks with some exposure to this rare earth thing. And we're going to get to that. So I wanted to kind of let you know that. First, I want to just kind of go through a little bit more and just highlight some of the key points. We showed our range here. And I think it's important also here that we essentially have, when we look at the S&P 500, this range, there is a short-term sort of bullishness, because you can see that the moving averages are in a bullish alignment with the 8-day over the 21-day. The rate of change is starting to kind of turn positive again. However, I do think we have to realize that in some ways you could say that this is really not necessarily an uptrend anymore. It is a sideways range. And I do want to emphasize that period of time between mid-April and mid-May of 2023, when we were waiting for them to raise the debt ceiling. The market entered a period of a kind of agonizing sideways movement. And right now, what are we doing? We're waiting for basically Trump and Xi to solve these trade problems. We're waiting for something to happen. I mean, the debt ceiling is also an issue again. So we're at a spot here where there's geopolitical or political sort of congressional stuff that we're waiting on that is keeping us stuck. And at the same time, there's a range here. So I think it's just important to realize that this is not terribly different than the spring of 2023. At that time, a lot of the AI stocks were running as the broader market consolidated. This time, we could be seeing weak dollar plays and some of the metals running as the overall market consolidates. The weak dollar plays kind of in effect. So let me just show you here. All right. So that was the main point. Also, I want to point out the treasury yields, and we have talked about this, is that basically, this was a level we had talked about on our State of the Market webinar a few weeks ago. We said there was this zone between 460 and 465 on the 10-year treasury would potentially be the spot where people will look for a kind of peak. But now look how it's just going back and continue to hold 432. That was the high. Let me hide myself here. That was the high from June of 2008. So again, we point out this level. That's exactly where we stopped. But now we're right back down to this long-term level we keep looking at. So I think this is something here we have to just kind of realize this remains in effect. And again, continued upside in TNX here could be problematic for the market. But also there are things to be more kind of dovish about when you look at things like the job market weakening today. Initial jobless claims higher than expected. It was the highest level in a certain period of time. I think it was the highest level in about 8 months. So it's a pretty high number. We've had continuing claims move higher. So some of these things here are potentially, dovish. And like I said, the Fed is now potentially, it's possible we've seen peak hawkishness, especially if there's some kind of light at the end of the tunnel in terms of the tariffs trade thing improving. That could put Paul in a spot when he's ready to be a little bit more Mr. Nice Guy. I mean, unfortunately, he's been put in a corner here where they all know that this inflationary thing could be coming from higher tariffs and shortages and all these sort of things that could happen. And now they're being asked to basically cut rates before that. And it's a very difficult thing for them to do. But if some of that sort of geopolitical trade risk goes away, they could be in a spot when suddenly they say, hey, wait a second, jobless claims are moving higher, oil's going lower, shelter costs are coming down, and maybe we're actually, getting to a spot where our policy looks more restrictive again, and that means that it justifies not being as restrictive, which means lower rates potentially. So, I mean, I think we just have to realize that remains in effect. All right, so wait a second, this is the old one. All right, so basically, all right, so you look at it. It was interesting to me to actually look. We always like to kind of dig in, and if you look on trade station. We have over here on our MT main. This has our key ETFs tab, and you can kind of look here, and you can look like in the last 21 days, for example. What do you see? The last month, semiconductors strong, solar strong, retailer strong, metal strong. I mean, the solar is kind of a wacky like rebound from a big drop, but overall the mix, industrials, technology, consumer discretionary. So these are risk on that it remains in effect. We're seeing strength, obviously, in some things like it's interesting, even like gold miners have been strong. But the key thing with a lot of this is it's all kind of risk. It's more kind of risk on focus, and it's also more of a thing that is a little bit of the continuation of this sort of weak dollar theme. The weak dollar we had in March and early April was a kind of catastrophic, crisis weak dollar. The weak dollar we have now is more of a kind of dovish, feel-good weak dollar, which means the Fed being dovish, risk moving away, a kind of more benign, general moving, of people selling the dollar and buying other riskier assets. And historically, that has been a positive sort of thing in the market. What we saw back in March and April was completely unusual historically. It's almost never happened before, and we discussed it thoroughly at the time. But it's important to realize that we can go back to a normal weak dollar trade, which simply means a more of a kind of positive risk on sentiment. It's interesting also to see here that things even like biotech, we talked a little bit, there's a trading view idea if you look, and then the global stocks overall, and also safe havens like utilities, healthcare are lagging. So that's just kind of something that these things overall are continuing to be more of a kind of risk on positive environment here. So I think we are in a spot where it does continue to kind of favor that expectation that the market could be range bound. We could see kind of low volatility stock picking for a while. And let's see. So I had an alert go off my other screen. I thought I silenced it. All right. So basically, it's interesting to see. Now, this is something that's always a little bit kind of concerning. I saw this week at least 2 Wall Street firms raise their price targets on the S&P. That's always one of those things that's a little bit, worrisome because they have a tendency to do that, at the end of the move. So just realize that's kind of interesting here. But look at the overall economic data here. So I did this data. All this was for last night, so I didn't get today's jobless claims in there today, but we did have higher claims today. We had a big negative reading on unit labor costs from Q1. Again, I think that data is just completely just bizarre because of everything happening with tariffs and this huge surge of imports. And so I'm not even going to pay any attention to that overall. Normally that would be kind of hawkish news, but I'm not going to give it too much heed. So overall, I think it's important to realize we had the payrolls were weak from ADP. The beige book, I've never seen the Fed's beige book say this. It actually said the economy was shrinking in the last 6 weeks. I've never seen them actually say something that clearly negative. And then basically the the Chinese data, also relatively weak. I want to emphasize here this idea that, and this is something I've been kind of saying throughout the last week, that we may have seen peak hawkishness. Inflationary data. So remember, we have the CPI coming next week, and I think it's important to realize that the shelter. I just keep beating the dead horse over shelter, but I think it's important to realize the shelter continues to be something that can cause a downward drag on CPI, which is a good thing overall. And the median rents, according to Redfin in May, were down 1% sequentially. Oil also kind of weak with OPEC just pumping out oil. And I think according to oilprice.com, the Energy Information Agency, which is part of the federal government, basically cited record supply and sliding demand. It was actually pretty, blunt. And then Morgan Stanley, basically here they are saying the dollar is going to fall 9% in the next year, expecting Fed rate cuts. So there we go. Again, same sort of thing. And then it's interesting that CNBC had an article saying that private equity firms are now buying stocks in Europe. So looking to buy companies in Europe. Again, this is exactly the sort of thing, weak dollar trade, people buying Europe and all that sort of stuff. Maybe it's a case where private equity goes, they're early and money follows. I'm not even sure if that's always true, but the point is it's just another kind of little piece of data that shows that we are continuing in this process of unwinding American exceptionalism as a trade. I'm not saying anything about America overall. I'm just saying that we had 3 years of massive outperformance. We had all this concentration in the US, high multiples, all that sort of stuff. And now for various reasons, some of it geopolitical, some of it normal rotation, money moving back to those international sort of trades. And we're seeing confirmation of it there. I don't know what this thing is called, IATA. It's the airline trade group, whatever that is. But basically, if you look at it, they cut their demand forecast for global freight cargo. Not a huge surprise, but there's just also something in there that would kind of also be kind of consistent with the overall dovish thing. All right, so then tonight, Broadcom reports earnings, and next Wednesday we have CPI. So just kind of remember that. Those are the kind of things out there. No, we also have, wait a second. I apologize. I don't have payrolls on here. Payrolls are tomorrow morning. I made a mistake, and I want to apologize for that. Tomorrow morning, we have non-farm payrolls, and that's a big catalyst. That's I'm going to add that right after. So sorry about that. All right, now let me kind of continue with some other things here. I wanted to also mention that all right, let's look over here on TradeStation. I have a special scanner set up. I have this special screen set up. Let me hide myself again here. I have a special screen set up to make it easy to read scanner. I'm not going to get into using this scanner, but this is a special scan I have called Find Sectors and Industries. And I'm doing this because I'm looking for metals and mining stocks that might have exposure. It's a very simple thing I'm looking for. When you see something thematic emerging, there's ways you can use TradeStation to find those themes. So I'm going to tell you right off before we even get to it. Some of the actual names that are popping up on my radar here are IPX. I'm not even sure how to pronounce the name of this company. It's kind of an unusual name. IPX. It has a metals. It has a rare earth potential. I'm noticing some of the price action in today. A lot of these are small sort of companies, and when people start piling into one thing, this is the sort of thing that sometimes they're going to be focusing on. So IPX, when they mentioned this one, this came from the scan. Hyperion. It has some exposure to rare earths. Another one is TMC. It's called the Metals Company. Also, some exposure here. It has been moving, not entirely on rare earths, but on something else. I'm not a mining expert, but it's something with nickel and cobalt. But this has been another one that has been following a similar sort of trade. Another thing that's interesting is Rio Tinto. Now, it's interesting to me, and again, I don't know I don't know why these companies have been so weak, or maybe it's because of China, but Rio Tinto, Vale, and BHP Billiton used to be like in the old days of commodities. These guys were just like complete giantly important stocks, and they've been just completely left for dead. But RIO has a degree of exposure. And another one that is interesting is Tech Resources, TECK. This is mostly a copper company, but they do have some other stuff. And if you look at this look at this here. I mean, look at this pattern on the look at this trend line break here. I mean, on the weekly. I mean, it's not exactly right, but I mean, you can see here that this is something. Now, I wanted to show you this other thing. This is copper futures here, and copper futures are, kind of advancing as well. This is something that benefits from a weak dollar. It's also interesting for people that are looking at things like the euro here. Now, these have futures associated with them. That's the euro, the Australian dollar. These are other ways that people would look to follow things like this. It's interesting to me to look at the way the Australian dollar here is kind of inching higher. And this is something that people might look for a potential breakout in the Australian dollar. This has futures on it. I don't actually know what they are. I have not traded Australian dollar futures, but they do exist and they're available. If you want to go to TradeStation, go to our products and go to the futures section, you can find those. Speaking of futures, I want to just remind you guys about platinum. We talked about platinum when this big move happened. We did an actual blog post on it back here on May 21st. And here it is continuing to, another, kind of long-term high here. I mean, to me, this is actually pretty interesting to look at, because the narrative on platinum, and we did this article on it at the time, but if you look at a long-term comparison, we also did a trading view idea on it, if you look here. But basically, I think it's an interesting, just to kind of bear in mind, is that, let me see, here's our trading view ideas. Platinum has lagged everything for a long time. And All right, platinum may be coming to life. We did this article back on TradingView on May 21st. But look at this comparison. This is platinum to gold as a ratio. So if you actually look at platinum where it was like 15 years ago in the heyday, I don't want to dig up all the history right now, but if you look back where it was in the heyday of precious metals in like 2006, it was much higher. I think it was like almost twice where it is now. And basically, you know, it's gone down for a long time, and gold has rallied and platinum has not. It's the same thing with silver. Silver and platinum have completely underperformed gold. And so the thing is, what if we get into a period here where people get into a frenzy for metals and precious metals? Then you're in a spot where something like platinum and silver that have underperformed for so long might be coming to life. Now, speaking of silver, silver here potentially having a breakout on the future. So I want to just point this out. This as well. This overall trend is something that we could continue because remember, look at the dollar index here. If the dollar index goes down on the weekly and fills this space, one of the trades that would be kind of something people would look for to express that could very well be metals. They have underperformed for like 15 years or something here, maybe 13 years. Since about 2011, they've been not doing much of anything. Gold itself's been doing okay, but most of the others have just been lagging. And even then, gold miners are nowhere. The stock prices of gold miners are nowhere close to where well, not really. Maybe they're getting there now with today's move, but they are still well below where they were back in 2008, 2010. And the point is that gold has like doubled or more than doubled since then, and the gold miners are still below their old highs. So this is an area where people might start to see some activity, and I think it's something I have to kind of emphasize, especially if the dollar gets down and fills into that space there. All right, so let's go over here to this scanner. I got to get to an idea. I'm going to give you. I don't want to just get to at the very end and get the option some option stuff. But anyway, so look, this basically is a scan, and it shows all of the sectors and industries that stocks are in. So what it basically is you go in here on scanner. Come on. And what you do is you go and you add the indicator that is called sector. And then you say not equal to quote, which basically means show me all the stocks that sector is not null or not a blank space, and all of them have a sector. So what that will do is that will return all the stocks and their sectors, and then you can sort on them. This is not cooperating with me right now. I can't show it to you. So I'm going to do is I'm going to just show you these results. So this one shows all sectors. So what I did on this one is I basically went down and I said I only want to see basic materials. Oh, here we go. I was clicking on the wrong thing. Come on. There we go. Why is it doing that? Anyway, you can see here that what I did was went to sector. In this case, I said equals basic materials in quotes. So that's basically how I could hone in on just basic materials. And then I have other things like I want to see market cap of at least 500 million, average volume of at least 500,000 a day or something like that, or maybe 50,000 to bring stuff up. But anyway, this allowed me to go through this list. I then took this list, I dumped it into Radar Screen, and I started looking for some names that were moving. I can actually just quickly show that to you. I go over here, go to MT main, and then we can go to something like our price grid. And we can just dump them in and we can then compare them. You can kind of look at the performance. But I want to get to Option Station Pro. I only have a second left. But basically, let's just very quickly look at Freeport here because, Freeport is there's not a lot of active options in this space. And so basically, Freeport here, FCX. Important copper stock. It's one of the few that really trades more than say 50,000 contracts a day, which could give that liquidity. But like when you look at a move like this, yes, near term it's overextended. What are the ways people can handle something like this? Say, for example, you believe or you have a sense that copper might continue higher, the dollar might continue lower. These different things might happen. A person might use in this case a calendar spread. So the idea potentially in a name like Freeport here could be to basically look at something like the normal expiration of July expiring on the 18th, and look at a level up here like 45. And a person, for example, could buy like these calls, and they could click on the ask, and then they go back to the shorter time period that expires in, say, 2 weeks on the 20th, and they could, let me expand this, sorry. And they could expand it to basically, you're going to go over here, and you're going to hold down the bid. And what this essentially would do is it would go out to this period in July, and it would buy them, and then it would sell the 20th of June, expiring in about 2 weeks. Then the idea would be, so that right off the bat would bring in, it would cost, something like 75 cents. And then what would happen is at a certain point in time, you could then, for example, the goal would be to let these expire. So you want them, for example, you want the stock not to go to that level by the first expiration, and then you can sell them again. And then again, because then you would basically get roughly 2 weeks is going to give you the best time decay in terms of that's the period of time when you get the most time decay in terms of collecting premium. So a trade like this could basically bring in 34 cents, bring in, say, another roughly 34 cents, and then, if you did that again, you essentially would bring the cost down close to zero. Now, that is the cost, assuming the stock remains in the same place. The idea is if the stock were moving higher, the calls that you own would be getting more valuable. So the thing is, if the stock moves higher, then next time you could sell something like the 46s or the 47s. Or what you could do is you could then sell something like the 47s or 48s in the same month that you own these Julys. And what that would then do is turn into a vertical spread. So by doing this, what you're doing is you're capitalizing on the faster time decay. If you look here at the theta, you can see that this month, these thetas, the theta of the 45s here, these are going to lose 2 cents per day, but these are going to lose 3 cents per day. So basically, with that, you're taking advantage of that faster time decay in the shorter dated options. The other one that stood out to me I want to talk about is Target. We did a trading view idea on this, and some potential kind of bearishness in the name here, like Target. And I just thought it was interesting also, a person in Target could look at something like the 90 puts of July and selling the 90s also of June 20th against them. And I don't have, let's see, I'll show this to you quickly. Jump over here. A person, for example, could click on the ask right there for the 18th of July, meaning they want to own those, potentially buy to open those, and then go to the 90s right here, expiring. Make sure I'm looking at the right expiration right here. Okay. And now a person, for example, would be paying $1.56 roughly for that trade. But then the thing is, in 2 weeks, if the stock is still above 90, they could sell more out of the money and bring in more time. And again, this is for something that's simply looking for the position over time to, for a stock to move in a certain direction, but you're not trying to peg an exact timing for it. So these are calendar spreads, and these are I want to point out. But to me, Target, you can look at our trading view idea on it today. There's a link at the top. But overall, it's it's a name where it has a lot of challenges. And from my perspective here, a lot of these kind of retailers may have some risks because slowing economy, and there's probably going to be some inventory disruption and merchandise disruption from all the trade and tariff stuff. And on top of that, Target seems to be in a spot where they are not, especially well positioned now in terms of product and merchandise. If you look at the results, they didn't need the Chinese trade war to hammer their stock. They just needed some kind of, not great product choices, and Walmart basically taking market share, which is really what's happened to them. And so they're in a spot where, secularly they're challenged, and there's no significant sign of it, turning around anytime soon. So that's why I wanted to mention something like that in Target. So it's great to talk to you guys. We'll be back on Monday for State of the Market. Remember, State of the Market, we look at the individual sectors. We look at the overall levels, especially the weekly charts, to kind of get a sense of where things are going in the overall market. And then we'll be back next week also with market trends. Great to see you guys. Don't forget, payrolls in the morning, Broadcom after the bell, and then CPI next week. See you guys. Have a great weekend.